So who holds them accountable on the amount of money they can lend?
Yes. Well, there is actually another variable that's been used to influence banks. And actually, it's a good point. Perhaps let's go quickly through this. I'm a professor of banking, and I was astonished to find that the experts, the textbooks, the researchers weren't even sure how banks actually work. And I found that there's three theories of banking, three theories of how banking works. Mm-hmm. And when we talk about banking, the key function that distinguishes banks from others is actually in their lending operations. And the key question there is, where does the money come from? Actually, one of my books, Where Does Money Come From, has this title. So where does the money come from that the banks use when they give out a loan? And that's where the three theories of banking are different from each other. Now, the currently dominant one, the mainstream theory that is pushed in the textbooks is, banks, they're not very special. Nothing to see here, move on. Mm-hmm. There's nothing special about banks. They're just financial intermediaries. That's the financial intermediation theory of banking. And they say banks lend out their deposits.
Right. Savings on the left, loans on the right, interest in the middle.
Yes, exactly. And with that theory, what regulatory tool to control banks is being used is actually capital requirements. Mm-hmm. So since the Basel Accords in the late 1980s, it's been capital that's been used mainly to get a handle on what banks are doing. And the idea is that this will control and restrict banks' activity so we won't have banking crises. Well, has that worked? Have we had banking crises since 1988? Tons of them. In fact, dozens and dozens. If you look at the whole globe, we had...
for some that don't know, you were with Bear Stearns for 14 years or 13 years, right?
Not that long, but I was at Bear Stearns Asset Management, Senior Managing Director, Senior Portfolio Manager. I was also at Jardine Fleming Securities before in Japan as Chief Economist.
So the reason why I say that is to say you're not just a professor, because sometimes, professor is seen as, the intellect who just stands up and talks and has never been in the operating room that's doing the work. You've been... in exactly. Both places. Yeah,
precisely. And in fact, that's the whole point, because I realized these academics and their theories are mostly wrong. And we have to hold them to account, and we have to actually ask the question, what is reality? How do things really work? So this theory that banks are just intermediaries, they gather deposits, they lend out those deposits, and we can use, therefore, bank capital requirements as a tool to keep the banks under control, is plain wrong. But I'll come to that. There's a second theory, and that's an older one that was dominant from the 1930s to 1960s, and that is the fractional reserve theory of banking. Now, a lot of people have heard this, and I'm sure you have, because you mentioned the reserve requirement, and that's important in this theory. This theory says when a bank lends money, it needs to have some excess reserves, and it will be using those for the new lending. And, if banks are all loaned up with their reserve requirements, they can't give out new loans. So they first need to have some excess reserves. That could be from the central bank helping them, but that's just the mechanics. Now, that theory was dominant until the 60s. And it did have an interesting feature that got a lot of people interested in this, namely the so-called money multiplier. So it says that each individual bank is just an intermediary. They gather deposits and lend them out. But in aggregate, as banks interact, using this reserve requirement, somehow there is leverage money creation happening, and therefore there's a money multiplier there. Now, that theory actually gave away the fact that there's something strange happening and banks create money, and that was too much for the powers that be to handle. That's why since the 60s they've pushed the financial intermediation theory, which says, there's nothing to see here at all. Money creation? Mm-hmm. No, it's not happening. But there's a third theory, and that's the oldest. And as it turns out, the one that's really true. It's the one that sounds initially slightly crazy, but it was dominant until the 1920s, 1930s. And that one said that, banks are not intermediaries. They're not financial intermediaries. Banks are creators of money. If you get a loan, this is new money creation. And the bank will create new money into existence. That's the one that you're getting when you take out a loan. We could talk about how this actually works and how they make it work. Mm-hmm. But there's these three theories. And that one has been suppressed quite a lot, but you also find, actually for each of the three theories, you find famous economists supporting them. Keynes, John Maynard Keynes, the famous 20th century British economist, he actually supported all of them in sequence. Now he moved, first he supported when he was young the credit creation theory, that banks create money out of nothing. Later he moved on to the fractional reserve theory, and then even the financial intermediation theory. So he moved away from the truth, as it turns out. Now I thought, well, this is ridiculous. We've got three theories. Which one is true? What's the scientific thing to do? Let's look at the data. Let's look at the facts. Let's do an empirical test. So I conducted the first empirical tests of banking and how do banks actually work and which of the theories of banking is true, which was the first empirical test in the 5,000-year history of banking, if you want. You can actually get this online if you just Google. One paper is entitled, "Can Banks Individually Create Money Out of Nothing?"
Can banks create money out of nothing?
Yes.
Individually create money out of nothing?
Yes. Because in aggregate, you see, that would be one of the theories, but actually individually out of nothing. That's the most radical one. That's the credit creation theory.
Is that the one?
That's it, exactly. And secondly, the other paper is called "Lost Century in Economics." That one also has the three theories of banking. It has another empirical test. These are two different types of empirical tests, and that's the one. And the conclusion is that the current dominant theory that banks are just financial intermediaries, that one is rejected by the empirical evidence, and also the theory that the fractional reserve argument, money multiplier holds, is also rejected. And the only one that is supported by the empirical evidence is the credit creation theory. Banks create money out of nothing. So it's now an empirically established fact.